A lot of business owners have been asking me, what exactly do you mean by the 4 C's of credit? And let me just try to demystify this. I'm John Kimani, CPAK. So at least I have some exposure and some experience. I've worked in a bank before. I'm a business owner. I'm an entrepreneur. So at least I have an idea about how the 4 C's of credit work in relation to borrowing and financing your business. Now, the first C, I have extensively talked about it. It's called capacity. And capacity is demonstrated by your ability to have cash flows in the bank or cash flows in a certain account. And these cash flows are also related to, profitability. But at one time, they may not necessarily be so. However, the bank or the circle or the funding institution will look at how much money is coming into your bank account and determine that if this person is having these cash receipts, then definitely if we applied some ratios, like for instance the gross margin ratio of about maybe 50%, then probably we can determine that this person is going to have such amount of money that can be able to pay his loans. If we can go an extra mile and apply another ratio called the profit margin ratio of maybe of 20%. So they will simply look at the cash flow and say, assuming 20% of this money is profit, then this person or this business owner can be able to pay for the loan and so on and so on. So that's why banks are usually very happy when they see a lot of money flowing through your account, because they are able to determine your ability to pay, your capacity to borrow, and so on and so on. So I would therefore encourage you, business owner, that ensure that as much as your business receipts go through your bank account, because this is going to help build your credit record, or it's going to be a signal to the banking institution or to the circle that at least you have some cash flow that can be used to pay for your loans. As they usually say, cash flow is king. And under accounting, we are usually able to convert cash flow in profitability and vice versa, profitability into cash flow. There are many approaches to doing that. So as much as you might think that your cash flows do not matter, they do matter, because a bank or a financial institution such as a circle would know whether you're making some good money or whether you'll be able to pay their loan or not. So capacity to borrow is extremely important. So, and the takeaway from this video is that ensure that most of your business receipts are actually going through your bank account, because this is going to be a very strong signal or a telltale sign that at least there's some money that can be used to pay off the loans that you have been lent to. Now, the second C is called character. And character basically tells us about who exactly are you as a business owner. Are you disciplined enough to pay? Do you have incidences whereby you have defaulted in the past? Can we be able to look at your records and see to what extent you delay the payments, the loan payments, and so on and so on? And this is a good indicator of the kind of person you are. Do you prioritize other people's loans, or do you simply say that as long as the money is in your hands, you don't have to pay people, and so on and so on? So banks will look, or financial institutions will look at your character before they can now determine to give you a loan. And one of the best indicators of character has been exemplified under the Credit Reference Bureau, whereby if you have defaulted, you are listed in the Credit Reference Bureau, and everybody who wants to give you a loan will be on alert that this person is a defaulter, and so on and so on. So the takeaway is that if you want business financing, can you improve your character? Can you ensure that as soon as you get money, prioritize the loans that you've been given by banks and SACCOs so that you don't wind up in the CRB list. That is a credit reference bureau list. If you wind up there, it's going to be very difficult for you to prove to anybody that you are trustworthy enough to be given a loan. Now, the third C is collateral. Now, this is something that I'll talk about extensively, because one of the reasons why businesses do not get finance is because they do not have assets that can be able to back up their borrowing capacity. I know most of us come from areas or from economic backgrounds that are not that are a bit poor, or that are not asset endowed, meaning you do not have acres and acres of land that you can put as collateral, or maybe you don't have fixed deposits that you can put as collateral for a loan, and so on and so on. So the question here is, therefore, what can you give as collateral to a bank or a financial institution so that it can give you credit? And of course, I know there are facilities that are what we call collateral free, like for instance salary loans. But we are saying, as a business owner, you might not have the luxury of a job, and therefore you may not necessarily have a salary. And if you have a salary, basically, therefore, you are going to be in a good position to be using that as part of the collateral and get us what we call a loan that is not necessarily tied to any collateral other than your payslip. But to majority of us business owners who would rather use the cash flow from the business as collateral then, or as borrowing capacity, then we need to ask ourselves the question of what else can we use as collateral. And one of the examples I would want to give is that you can use what we call the trust mechanism, whereby you can group yourself together with others, and this is something that has worked in the past, and all of you can be able to save deposits in a SACCO, and then from there you can co-guarantee each other, and this is going to be one of the most powerful ways in which you can get a sizable loan. Otherwise, if you simply save or put deposits, that is what you call a back-to-back loan, and it's not going to be significant, and you'll have tied all your cash flows into that SACCO. But the moment you save, and another friend of yours saves, and another friend of yours saves, and then you co-guarantee each other, you use what we call the trust mechanism among you to ensure that you get a good loan, then that can be a winning opportunity for you as a business owner to get finance. Now, this is a tried and tested method for those who have been asking me about how exactly do I grow my business and I do not have assets for collateral. I would recommend that you join a SACCO. I would recommend that the friends that you have, you need to come to a discussion about how you can leverage on each other's savings and deposits so that you can borrow a sizable amount from the bank and grow your business. If you do this, definitely it's going to increase the ability of your business to grow, because you're going to be having ready finance anytime you need, because all you just need to do is just call on your friend to guarantee you a loan, and then from there on you're going to get that loan. Now, if you have another way of how this can be achieved, comment, make a comment so that we can also learn from you, and so on and so on. And of course, the last C is capacity. It's not capacity, it's actually a capital. How much are you putting on the table? The bank wants to see how much you are financing other than whatever it is that you're borrowing from them. So you need to be able to prove to them that they're not handling the whole risk alone, and that you're also investing in this business. And when that happens, then the bank or SACCO is now in a good position or trusts you more